Hello everyone, welcome to Cheongfuli Weekly Report. Here we bring you the latest China's steel market prices and analysis every week. This week, market pessimism gradually materialized as steel prices continued to weaken during the off-season. Domestic hot-rolled coil spot prices fell by 60 yuan per ton this week, while rebar prices dropped by 30 yuan per ton. At the macro level, Trump's tariff policy has been fraught with twists and turns. After the International Trade Court ruled the tariffs invalid, the Federal Appellate Court filed an appeal, and the case is now pending judgment by the Supreme Court. During the Dragon Boat Festival period, Trump escalated the tariff policy on imported steel and aluminum, increasing the rate from the previous 25% to 50%, which may further dampen post-holiday expectations for international trade. Domestically, the recent macro policy vacuum has led to slow transmission of tangible improvements in consumer demand following reserve requirement ratio and interest rate cuts, with steel demand showing minimal impact from policies. On the industrial front, the weekly output of the 5 major steel products increased by 80,100 tons, driven by the conclusion of recent maintenance activities. Hot-rolled coil production alone rose by 138,700 tons. The off-peak electricity costs for electric arc furnace steel have increased, leading to a recent decline in operating rates. In terms of demand, pre-holiday inventory replenishment increased, with weekly apparent demand rising by 93,200 tons. However, increased rainfall across regions during the Dragon Boat Festival may further depress post-holiday demand. Regarding inventories, although the overall inventory of the 5 major steel products is being reduced, the pace of destocking has slowed amid declining molten iron production. It is important to note that the steel demand off-season is already underway, and the decline in demand is set to accelerate. Due to the earlier drop in coking coal prices, steel mills have maintained healthy profits and even increased production during the off-season. Consequently, as demand further deteriorates, the market may focus on squeezing steel mill profits, with the risk of further negative feedback as inventory accumulation accelerates. Entering June, steel prices are unlikely to reverse before mills implement further production cuts, and prices may continue to weaken. For procurement, it is recommended to focus on meeting immediate demand. The basic logic of short-term continuation of supply pressure, downward cost shift and tariff disturbances remains, and there is still a lack of clear guidance in the domestic macroeconomy with insufficient incremental expectations. Steel Union data shows that hot metal production continues to decline, and superimposed on the background of the off-season, the space for demand release is limited, so the prices of black metal varieties have shown a spiral decline. Shorting in June is still in line with the trend, and the conditions required for expecting a price rebound are difficult to appear. In the future, it is necessary to observe the extent of the continued decline in hot metal production, and the expectation of weak oscillation and follow-up decline is maintained. In summary, as demand further declines during the off-season, it is still recommended to replenish inventory only based on rigid demand. In terms of product varieties, billet and coil products are recommended. Okay, feel free to leave your thoughts, questions, or any related inquiries in the comment box below. And if you found this video valuable, don't forget to follow us for more updates. See you next week.